Okay, guys, welcome to the Jet Janix channel again today. And today we are going to discuss the straddle versus strangle strategy for currency options, okay, or any other option we can avail these two strategies. So today we are going to see the difference between the straddle and strangle strategy. These are the two strategies which we use for option trading, okay, and the straddle and strangle strategy are almost the identical, but there is only one difference, okay. And how we are going to capitalize on that difference, today we will discuss it, okay. So let's come and discuss it. For various reasons, a hedger and speculator my own combination of options. Two of the most popular combination are straddle. Okay, the first one is straddle. Long straddle involves buying both call and put option, and short straddle involves selling both call and put option. Okay, and in straddle strategy the exercise price are identical in both cases, which means when you want to buy the put option or the call option, the strike price for both will remain the same, okay. But in strangle is not the same. The exercise price will not be the same for a call option. It might be different from that of the put option. Okay, this is the main difference between the straddle and strangle strategy. Okay, so strangle are almost identical to straddle, but exercise prices are different. Now, how can we use both of these strategies for option trading, and how can we get benefited of these strategies? Uh, let's do it or understand it with an example, okay. So here you can see a long straddle means when you want to buy the call option and put option at the same time on the same exercise price, okay. So if you see here this one, we have the call option premium or the call premium, that is zero point 0.03, and for the put option the premium is 0.02, okay. And for the both cases, for the call and put option, the strike price remain 0.6, okay. And let's assume that the option contract or the size of the contract is $50,000, okay. So now let's say that you bought the call option and you bought the call option and you bought the put option. Sorry, guys. Put up you bought both call and put option, and on the zero point 0.6 price, okay. So you enter into the call and put positions. The call premium and the put premium are different, but the exercise price, if you can see here, is remain the same, okay. So now let's say that if the spot price came to 50.5, okay, what will be the result of this strategy you have just executed, which means you have bought both call and put option at the same exercise price. So if the price came to zero point 0.5, you are going to lose $0.03 on a call option, but you are going to have a 0.08 on your put option, okay. Because why? Because this is one you have put or you are going to sell. So now the price is very favorable for you. You have sold on 60 and you will buy it on 50. That's why you are earning 0.08, and the net result is 0.05, which means we can benefit from this price, okay. Now let's assume that the price goes to 0.55, which is here. So we are going to lose 0.03 on our call option, and we are going to have 0.03 on our put option, and the net result is 0, okay. And if the price remain at zero point 0.6, we will lose 0.05, okay. And now if the price further goes up like the 65, 70 and 75, we are gonna gain some amount or some return on our call option, but we are going to lose on our put option. and as the price goes up, our losses goes up as well. Okay guys, so this is what we call the straddle strategy, in which we have bought both call and put option on the same exercise price. Okay, and we can benefit from this strategy if the price moves more and more in only one direction. Okay, like for example, if the price goes to 50 or less than 50, we will benefit from the put option. Of course, we will lose only 0.03 on our call option. And if the price goes to 75, 70, 75 or 80, then we are going to have some return on our call option, while we will lose only 0.02 on our put option. So this is the way how we can trade the options, and how can we get benefited from the straddle strategy. For the straddle strategy, it is very necessary that in order to have some good profit, that the exercise price, sorry, the spot price move must move or increase or decrease to huge extent. I mean, it must move from 60 to 75, 70, 75, 80, or it must move or come down to the 40 or 45 or 50 in order to have some profit. Okay, now come to the strangle strategy. In strangle strategy, as I told you, we will buy, or we will buy or purchase the call and put option both on the same time, but with different exercise prices. Okay, if you can see here, the call option premium is 0.015, put option premium is 0.02. It's okay, these are two different, so it's okay, it was different in our previous example. Okay, as well. Now the call option strike price is 0.625 and the put option exercise price is 0.7572. Okay, there is a difference between the exercise prices of call and put option. Okay, and again the contract size is 50,000. So if the price, the spot price, goes to 525 or 0.525, we are going to lose some money on our call option, and here, and we are going to have 0.025 on our put option, and the net result is 0.01. Okay, and if the price goes up, I mean from 525 to 575, 625 and 675, you see, in these two conditions we are losing on our call option, and here we are having some return on our put option. But in this case we are going to lose 0.04. Okay, and here in 622 again we are going to lose 0.04. But if the price goes further from 675 to 680, 85 and 90, sorry guys, this amount, it will exaggerate, it will be increase, and thus we can get benefited of this strangle strategy. Okay, so this is the strangle strategy, and for both strategies, either is it straddle or is it a strangle, in order to have profit, the spot price must move more and more. I mean, it must increase or it must decrease, but not to a very minute limit, but to the huge extent. And then you can have some profit from these two strategies. Now, if you like our video, please like, share, and share with your friends, and subscribe to our channel. Okay, guys, thank you and bye bye.